Welcome back to The Explainer. Today, we're bringing that high energy, that Dowell Street swagger, and we're totally flipping the script on what's, let's be honest, often feels like a rigged stock market. We're drawing on some incredible insights from Ashwani Gujral and Rachana Vaidya's masterclass on intraday trading. We're going to dive into how to not just survive the ruthless battlefield of the market, but actually profit from the exact traps designed to take your money. So be honest with me for a second. Have you ever bought a breakout only to watch it completely crash just seconds later? Have you gotten trapped here? Bye. You know the feeling. You see a stock surging, breaking right through resistance, volume looks amazing, you hit buy, and literally instantly the green candles vanish, red floods your screen, and boom, your stop loss is hit. It's just incredibly frustrating, right? That painful, stomach-dropping moment is exactly what we're breaking down today. And hey, your frustration is totally valid. So what actually just happened there? Well, you fell straight into a market trap. That's a sudden, sharp reversal engineered specifically when big institutions trigger retail stop losses. Think of the market as this ultimate David versus Goliath battlefield. The big boys, right, these massive institutional players, they need liquidity to fill their huge orders. And where do you think they get it? From us. They engineer these fake breakouts to trick novice traders into buying, and then they slam the price down, feast on your triggered stop losses, and accumulate their own positions at a massive discount. They're literally hunting your fear. All right, to stop being the prey, we need to build up our trading arsenal. Today, we're looking at 3 techniques: fading ranging markets, catching trend resumptions, and spotting the trend end. Let's lock in and load up that first weapon. Technique 1, the ranging market bloodbath. So the source material points out something crucial. Markets actually spend way more time just moving sideways in a range than they do in a clear trending direction. And because the market is just ping-ponging between a ceiling and a floor, these tight ranges are the absolute prime hunting grounds for institutional traps. Take a look at the Nifty index here. It's moving sideways, building a super clear range. Then, out of nowhere, it looks like a massive breakout. The bulls rush in, thinking it's going to the moon, but look closely at what happens next. The breakout completely fails. Zero follow-through. The big boys pull the rug, and the price just plummets. It's honestly like watching a tense IPL match where a batsman steps out for a massive 6, totally misses, and gets stumped. As those trapped long players realize they've been faked out, panic sets in. They dump their holdings all at once, which creates this violent slingshot downward to the opposite side of the range. The fear of those trapped bulls is literally what fuels the market's fall. Okay, so how do we actually profit from this mess? Well, here's the jugad, the clever hack to fading this trap. Step 1, patiently wait for that failed breakout or breakdown right at the range boundary. Just let everyone else rush in. Step 2, watch for that exact moment when the trapped players realize they're caught and they start to panic dump. And step 3, whatever you do, don't panic. While they're crying over their triggered stop losses, you aggressively enter the reverse trade in the opposite direction. You're basically surfing the wave of their panic. Sure, it requires ice in your veins, but man, it is incredibly profitable. Moving right along to technique 2, mid-trend shakeouts. You know, even when a market is genuinely trending upward, it never goes in a perfectly straight line, right? It takes breaks. And it's during these temporary mid-trend dips that retail traders get totally spooked. Check out this phenomenal setup in Seat Tires. The stock is in this beautiful, strong uptrend. Then, bam, we get candle 1, this giant red candle that abruptly halts the trend. If you're a nervous retail trader, you see that giant red bar and you probably sell everything in an absolute panic. But wait, look at candle 2. It dips lower, probing the depths, but then the buyers step back in and it actually closes higher as a green candle. And then candle 3 shows up, a strong green candle that closes even higher. The temporary shakeout is totally over and the bulls have completely overpowered the bears to get that uptrend going again. So the absolutely crucial part is knowing exactly when to pull the trigger. Here are the strict rules for this puka resumption setup. First, spot that big red countertrend candle that stops the uptrend. Remember, that's your warning sign to pay attention, not to panic. Second, look for the very next candle to try and go lower, but fail, and eventually close green. This tells you the selling pressure has been totally absorbed. Finally, you enter on the third candle as the original trend clearly fires back up. When you execute this properly, you're not just guessing, you're stepping right in to buy the dip alongside the massive institutional players. All right, our final strategy. Technique 3, the 50% lifeline. So how do you actually know if a dip is just a temporary trap or if the whole trend is dead in the water? Well, it's all about context. Distinguishing between a healthy temporary correction and an absolute trend reversal is literally a survival skill. The contrast between these two views of Dish TV gives us a massive clue. Looking at the intraday movement, it looks like an absolute bloodbath. The price is plunging violently, dropping like a complete rock. If you're only looking at this tiny, zoomed-in time frame, yeah, you're terrified. But zoom out to the higher time frame daily view. That terrifying intraday plunge, it stopped exactly at a major, solid historical support level. Keeping an eye on that bigger context totally flips the script. It saves you from getting chopped up in the intraday chaos and lets you spot the precise moment the stock is about to bounce back up. And that brings us right to Ashwani Gujral's golden rule, 50%. It's beautifully simple. As long as a counter-trend move, like a dip or a correction, erases less than 50% of the previous upsurge, the trend is still totally alive, boss. Markets move kind of like a dance, right? 2 steps forward, 1 step back. As long as that backward step doesn't wipe out more than half of your forward progress, you keep the faith, you hold your ground. Anything beyond 50%, however, and yeah, you need to seriously doubt the trend and protect your capital. Profit like the big boys. Okay, so we've covered the tactics, but now we really need to talk about mindset. Because to truly survive and thrive on Dalal Street, you have to undergo a complete mental shift. Stop trading like prey and start thinking like a predator. The contrast is harsh but true. Your novice trader plays head-on against the institutions, which, let's face it, is a guaranteed way to get crushed. They give into FOMO, buy at extreme highs right when the smart money is actually selling, and worst of all, when a trade goes against them, they stubbornly average down and just pray it comes back. Don't do that. On the flip side, the smart trader plays alongside the institutions. They wait patiently, they only buy from deep, proven support levels, and most importantly, they are agile. They'll happily jump back into a trade when they see a trap fail, completely taking advantage of that shifting momentum. Which leads us perfectly into this core philosophy directly from our source material: stay humble, nimble, and accept the market as the master. Look, ego has absolutely no place in the futures and options market, none. If you're wrong, the market is going to punish you mercilessly. So don't argue with it. Don't stubbornly hold on to opinions when the price action is screaming the exact opposite at you. Accept the loss, get out quickly, stay nimble, and just wait for the next clearer setup. At the end of the day, the market is always right. I want to leave you with a final, kind of provocative thought here. The next time a sudden red candle appears on your charts tomorrow morning, will you be the trapped prey or will you be the trapper? By understanding how to fade ranges, how to spot 3-candle trend resumptions, and respecting that 50% lifeline, you actually have the tools to make that choice now. You know how the big players operate, and you know how to ride their coattails straight to profit. Now it's time to master your own trading psychology. Thank you so much for joining me on this explainer. Keep those charts open, stay sharp, and I'll see you next time.